I can't help with bypassing or beating reused content detection systems, but I can give you a fully original rewrite in the same pacing energy style, with fresh wording and structure. Tonight, I need you to stay with me, because what's happening in the gold and silver space right now is not just another good week, and it's definitely not a quiet little bounce that fades away. We're watching a pressure cooker build across metals, mining stocks, and the global resource system at the exact same time, and the people who understand the setup early tend to do absurdly well when the crowd finally notices. So in this video, I want to connect the dots in a way most coverage refuses to do. We're going to talk about why the big producers are suddenly printing cash, why the smaller miners are starting to wake up after years of being ignored, why deal-making is quietly heating up behind the scenes, and why the scramble for critical minerals is turning into a geopolitical contest that could reshape the entire commodity cycle. Now, quick thing, right after this hook, I need one small favor. I'm running a campaign to clean up this space, because copycat channels are popping up, recycling the same talking points and flooding the algorithm with low-effort noise. If you want to support me while I push back on that, subscribe right now and drop a quick comment. Literally, just type Arjun AG so the algorithm knows you value this work. And one more fast note before we dive in. If you want daily updates, quick posts, and my personal analysis that I do not always share on YouTube, plus instant voice notes when something breaks, I created a WhatsApp channel. The link is in the description. Join it, because it's where I drop premium, real-time context when headlines are moving too fast. Alright, jumping in. For years, people complained that nobody cared about mining stocks. The money showed up for a short moment, the hype faded, and then it was like the whole sector got tossed into a closet and forgotten. But markets don't work like feelings. They work like math, cash flow, and incentives. And right now, the math is forcing attention back into the sector. Start with the obvious. The metal prices are high, and they've stayed high long enough to change behavior, when gold is sitting at levels that used to sound like a fantasy. And silver is holding prices that would have felt ridiculous not that long ago. Producers aren't just surviving, they're stacking profits. And here's the part most people underestimate. A high price is one thing, but a high price with controlled costs is a totally different beast. If costs were rising at the same speed, this would be less impressive. But the story coming into 2026 is that margins have widened, and that margin is real. That means cash is building up. Balance sheets are improving. Suddenly, even conservative investors start paying attention. Now, when big companies start reporting quarterly and full-year results, that's when you get the headline shock. People read record revenue and surprise earnings, and then they finally realize what the higher price environment is doing to miners' bottom lines. It's not a theoretical benefit anymore. It's visible, audited, and impossible to ignore. But here's where it gets interesting, because the big producers, the household names, are only one layer of the story. And the truth is, the majors often move first because they're liquid, they're familiar, and big money can buy them without thinking too hard. But once the majors have their run, the next rotation tends to happen, and that's when the smaller names start catching bids. Why? Because the smaller names have something the majors don't. Optionality. The majors already produce, they already have established mines, so when the metal price rises, their earnings improve, but there's a limit to the surprise. Meanwhile, a smaller producer or even a developer can go from barely works to cash machine with the same price move. An explorer can go from nobody cares to target for acquisition, simply because their ounces in the ground become more valuable. So the question is always the same. Where is the best risk-adjusted opportunity? Steady majors or volatile juniors? And the answer is annoying because it depends on your goals. If you want stability, liquidity, and you want to sleep at night, the bigger names can make sense. But if you're trying to capture the phase where a sector re-rates from dead money to must-own, the juniors are where the fireworks can happen. Now, I'm not saying you go all in on microcaps and pray. That's not what adults do. But I am saying the market environment is changing in a way that often creates a second wave. First wave, the big names run. Second wave, capital flows down the quality curve, chasing higher leverage to the metal price. And if you've been around long enough, you know how violent that second wave can be. So what are we seeing right now? We're seeing financing windows open. We're seeing investors willing to fund projects again. We're seeing private placements and strategic money looking for exposure. And most importantly, we're seeing the beginnings of that conversation you always hear right before a real bull market expands. What are companies going to do with all this cash? Bored. Because when miners are broke, it's simple. They dilute, they survive, they cut costs, they beg for financing. When miners are flush with cash, the decisions become strategic. pay down debt, increase dividends, buy back shares, acquire new projects, start building, expand mills, increase exploration, all of the above. That's the champagne problem. And once that admission happens, policy begins to change. You start seeing initiatives to build domestic production. You start seeing governments talk about price supports. You start seeing state-backed financing. You start seeing strategic stockpiles. You start seeing partnerships between countries. You start seeing capital directed into supply chains, from the mine to processing to refining to manufacturing. And in a world where supply chains have become a weapon, this matters. Because if one country controls processing or controls refining or controls trade routes, it can squeeze others. And the response from squeezed countries is to build redundancy and security, meaning new projects, new permits, new investment, and often higher prices. So yes, it is very possible that we are moving into a commodity environment that looks less like free market equilibrium and more like strategic accumulation. Now here's where it gets even more interesting. Government involvement can be bullish for certain projects, but it also introduces new risks. And I'm going to say this carefully. When something becomes strategically important, it can attract state power in ways that investors are not prepared for. This is where the conversation about resource nationalism shows up. It can look like higher royalties. It can look like increased taxes. It can look like forced local ownership. It can look like contract renegotiations. And in extreme cases, it can look like expropriation. And before someone says that can't happen, let's be honest. History is full of examples where it happened. Usually, when prices rise, governments see profits and think, we want more. Sometimes they do it legally, sometimes they do it brutally, and investors have to understand that this is not a fantasy risk. It's a real-world risk that has already happened multiple times across multiple continents. So if you're going to chase frontier opportunity, you have to balance that potential upside with that political tail risk. Now, let's not get too negative, because the other side of this story is that many places are actually improving their investment environment. Political changes can shift policy from hostile to friendly. Countries can realize that mining is a way to bring in foreign currency, stabilize budgets, and create jobs. And when they do, you can get a sudden reopening of opportunity in places that investors had written off. This is why you see narratives swing. One year, a country is uninvestable. The next year, companies are getting permits and financing again. The market is dynamic, not static. Now let me drop in something creative and quick, because some of you asked for more success stories. If you are the kind of person who loves hearing how real people actually built results in silver-related opportunities, there's a second channel linked in the description that focuses on those stories. If that's your thing, subscribe over there too and see how different strategies played out in real life. Alright, back to the main thread. A big part of what's fueling this whole setup is the generalist investor. For years, generalists stayed away from mining because the sector felt like a disappointment. Too much dilution, too many broken dreams, too many next big discoveries that never turned into cash flow. But bull markets don't ask for permission. When the numbers get big enough, they force a narrative change. Here's what happens. First, the specialists buy, the people who live in the sector rotate. Then the big ETFs start moving. Then the majors become impossible to ignore because they're hitting 52-week highs. Then slowly generalists start looking. They don't buy because they love mining. They buy because they don't want to miss performance. And once generalist capital starts flowing, the sector can move like a different animal. Because the mining market is small relative to global capital pools, a tiny shift in allocation, just a fraction of a percent, can create outsized moves. This is why you can see ridiculous rallies when the gate opens. So the question you should be asking yourself is, are we early or are we late? Because the answer determines whether you're positioning or chasing. In my view, we're in the phase where the foundation is obvious to insiders, but the crowd is still catching up, and that's usually the sweet spot for building positions thoughtfully without the emotional mania. Now there's another lever in this story, returns to shareholders. A lot of investors won't touch miners unless the companies behave like grown-ups. That means better capital discipline, real dividends, buybacks that matter, and a clear plan for how they allocate cash. If miners start increasing dividends meaningfully, that becomes a bridge to a whole different investor base, the people who want yield and stability. And if that bridge opens, it can pull more capital into the space. But we should also talk about a key skepticism. Some investors argue that if you go into smaller names, you accept huge downside. And that's true. Juniors can be volatile. Projects can fail. Financing can dry up. Permits can stall. management can make mistakes. So how do you play it? You diversify, you focus on quality. You look for assets with real economics, not just stories. You prefer teams that have built mines before. You watch cash positions. You watch the financing environment.